You've spent years building up savings, but one drunk driver, one house fire, or one surgery could wipe it out in a week. Let's slow that down for a second. Picture this: same disaster, two families. Same kind of car accident, or the same house fire. One family loses their home and their future. The other has a horrible week, writes a painful check, but keeps their savings, keeps their house, and keeps their long-term plans mostly intact. What's the quiet difference between those two families? The difference is how they used insurance, not as a lottery ticket, not as an investment, but as a shield. So think about a family earning $80,000 a year with $40,000 in savings. A $250,000 medical event, a lawsuit after a car accident, or a house fire that causes $300,000 in damage, that doesn't just hurt, that can wipe them out and push them into debt for years. Your investments, your budget, your savings plan, all of that assumes that normal life keeps going. Insurance exists for the moments when normal life doesn't. And here's the key idea: the goal isn't to cover every little inconvenience. The goal is to stop one big disaster from undoing a decade of progress. In this episode, you're going to build a practical insurance checklist: what to prioritize, what to skip, and how to decide how much coverage you actually need, based on your own numbers, not an insurance agent's pitch. Let's start with step 1, using insurance as a shield by mapping your real risks. First, list out the things that would be truly hard to recover from. Not annoying, devastating. Things like losing $60,000 of income for a year, a $200,000 lawsuit or liability judgment, a $350,000 house fire. Now, compare each of those big risks to the buffers you already have: your savings, family support, your ability to move, sell assets, or cut costs if you had to. For example, if your emergency fund is $15,000 and your annual income is $90,000, you can handle a $1,500 car repair. It's annoying, but you're fine. But a $120,000 income gap from a disability, that's not just uncomfortable, that's a can't-absorb risk. This episode is going to help you match your insurance to those specific can't-absorb numbers. Now let's break your protection plan into 4 big areas. Think of each one as a simple math problem you can actually solve. 1. Health insurance. Here's where to start. Look up 3 numbers on your health plan: the deductible, the out-of-pocket maximum, and the co-insurance. Let's say your out-of-pocket max is $7,500 and you've got $3,000 in savings. That means your health gap is $4,500. That's the amount you'd have to scramble to find in a worst-case year. So what can you do about that? You've got 2 levers. Work toward building savings up to that $7,500 number, or choose a plan with a lower out-of-pocket max, even if the monthly premiums are higher. The key point is, don't just pick a health plan based on the monthly premium. Always ask, if the worst year happens, what's my maximum out-of-pocket, and can I actually cover that? Let that sink in for a second. 2. Income protection, disability. Now let's talk about your paycheck, because for most people, your income is your biggest financial engine. Say you earn $70,000 after taxes. That's about $5,800 per month. Your basic monthly expenses, housing, food, debt minimums, insurance, childcare, add up to $4,200. Your employer offers long-term disability that replaces 60% of your income after 90 days. 60% of $5,800 is $3,480 per month. So your monthly budget looks like this in a disability situation. You need $4,200 to cover the basics. You'd get $3,480 from disability. That leaves a monthly gap of $720. Over a year, that's $8,640 you'd have to cover somehow. So what are your options? You can build your emergency fund so it can cover at least 6 to 12 months of that $720 gap. That's roughly $4,000 to $9,000. Or buy a supplemental disability policy designed to cover that missing $720 per month. See how concrete that is? You're not just saying, I guess disability insurance is important. You're doing the math on your exact shortfall. 3. Life insurance if someone depends on your income. Now, next up, life insurance. This only matters if someone is counting on your income, kids, a partner, maybe aging parents. Let's walk through an example. Say your household needs $50,000 per year from you to cover essentials. You want that covered for 15 years, long enough for kids to grow up and the mortgage to get smaller. So you multiply. 15 years times $50,000 per year equals $750,000. Then you add $150,000 remaining on the mortgage. $20,000 for final expenses and a small buffer. Now you're at about $920,000. So it makes sense to target roughly $1 million of term life coverage in that situation. Again, there's no magic in the million, it just comes from your actual numbers. 4. Home and auto liability. Finally, let's look at home and auto liability coverage. The stuff that protects what you already own if someone sues you. Imagine you have $60,000 in home equity, $40,000 in investments, and $10,000 in savings. That's $110,000 total at risk, and in some states, that doesn't even include retirement accounts, which might be protected separately. Now suppose your auto policy only covers $50,000 of bodily injury per person. If you're sued for $300,000 after an accident, that gap threatens everything you've built. Here's the good news. Increasing your auto and home liability limits to something like $250,000 to $500,000 per person is often only a few extra dollars a month. And as your net worth grows, say it rises above $300,000 to $500,000, it's often worth pricing a $1 million umbrella policy on top of that. Umbrella coverage sits above your home and auto and gives you an extra layer of protection if a big lawsuit blows past those base limits. So those are your 4 big risk areas: health, income, life, and liability. Work through each one with your own numbers. The goal is simple. For every can't absorb risk, either build enough savings to handle it or buy targeted insurance to transfer it. Everything else? That's optional. Now let's zoom out and use a mental picture. Think of your finances like a bridge you've built. Your savings and your income, that's the main structure of the bridge. Insurance is the extra support you add only where the drop below is deadly. Here's an example. You've built a $25,000 emergency fund and you're investing $600 a month. With that kind of cushion, you do not need insurance for a $300 flight delay or a $700 phone. Those are small potholes. You can walk across that part of the bridge on your own cash. But now picture this. You cause a 3-car accident with $420,000 in medical claims. Or a guest gets injured at your home and it leads to a $350,000 lawsuit. If your liability coverage stops at $100,000, your bridge suddenly has a 200 to 300-foot gap. A smarter design would be, raise your auto and home liability limits to $500,000 each. Then add a $1 million umbrella policy on top. You might pay around $250 per year for that umbrella, about $21 a month. In return, you've added roughly a $1.5 million safety rail around what you've built, without overbuilding in the low-risk spots. Here's a simple lens you can use every time you face a risk. Ask yourself, if this went wrong, would it be a $500 problem, a $5,000 problem, or a $500,000 problem. Save for the first two, insure the last. As your income and assets grow, your risk profile changes, so your coverage should change too. Every 2 to 3 years, do a quick review. If your household income goes from $40,000 to $90,000, and your net worth jumps from $10,000 to $120,000, you're just not the same household anymore. That might mean raising liability limits once your non-retirement assets pass around $100,000. Increasing term life coverage when you add a $300,000 mortgage or have a child. Trimming small, unnecessary coverage, like extended warranties, once you're able to comfortably absorb a $1,000 to $2,000 surprise. Think of it as updating the blueprints on your bridge as it gets longer and stronger. Before you buy any new policy, hit pause and do this. 1. List your top 5 risks. 2. Put a dollar amount next to each one. That might look like, can't work for 2 years equals $80,000. Lawsuit risk with a teen driver equals $500,000. Then, when you compare insurance quotes side by side, ask one question. How many dollars of true disaster protection am I getting for each $1 of premium? Favor the policies that clearly win that math. That's how you stop buying gimmicks and start buying real protection. So let's wrap this up with a clear, simple action plan for this week and a quick recap. First, your action plan. 1. Take a few minutes to jot down the key ideas from this episode about insurance, protecting what you build. Writing it down makes it far more likely you'll remember and actually use it. 2. Look at your own life and pick one specific area this applies to right now. Maybe it's your health plan. Maybe it's your liability limits. Maybe it's finally getting term life. 3. Take one small action this week. Get a quote. Log into your benefits portal and check your disability coverage. Update your liability limits. Even a tiny step counts. If you do just those 3 things, you've turned this episode from information into progress. Now, here's what we covered today in plain language. First, we talked about what insurance is really for. Not to cover every little hassle in life, but to stop one major disaster from wiping out everything you've built. Second, you learned how to put real numbers to your biggest risks: health, income, life, and liability, so you're not guessing. You're seeing the actual gaps. Third, we looked at that bridge picture. You use your savings and income to handle the small stuff, and you bring in insurance only where the drop would be deadly. Those $500,000 disasters. And finally, you saw how to keep your plan alive over time. Review your coverage every couple of years, raise protection as your wealth grows, and cut the little stuff once you can afford to self-insure it. So here's your power move going forward. Use this simple rule to guide you. Save for the bumps, insure against the cliffs. When you do that, when you aim your insurance dollars at the truly catastrophic risks, you protect what you've built, you protect the people you love, and you give your future self a much safer, much more stable bridge to walk across. And that's exactly what smart insurance is meant to do.